Namaste and welcome to the very first video on this channel. Today we are going to discuss a topic which has been creating a lot of trouble for retail investors like you and me for more than a year now. Is there a relationship between inflation and investment? Do people invest more during inflation or do they tend to invest less? How does inflation affect the stock market? Do some sectors and stocks perform better than others during inflation? Let's find out. What is inflation? Well, inflation is a general rise in prices. Prices of commodities and services across all sectors go up. This rise in prices of goods and services reduces the purchasing power of the currency. This also means people have less disposable incomes, which means less money is left for investing. What causes inflation? At the annual meeting of Berkshire Hathaway of 1986, Mr. Warren Buffett said, "Inflation is a political phenomenon, not an economic one. Politicians lack self-restraint and will print a lot of money." Mr. Buffett said, down the road, he expected rates of inflation never seen before. 37 years later, in 2023, his prediction could not be more accurate. Inflation is a direct outcome of monetary policy. What is monetary policy, you might be asking? Well, in short, it's a way of deciding how much money supply or cash should be there in the economy. In macroeconomics, the relationship between money supply and the size of the economy is explained by the quantity theory of money. The size of an economy is usually measured as gross domestic product or GDP. For the sake of understanding, let's take the example of the world's largest economy, the USA. The GDP of the USA is roughly 25% of the global GDP. But the amount of dollars in circulation worldwide is estimated to be as high as 88% of all currencies. I hope now it's quite clear why inflation has been such a big problem. Now let's understand how central banks deal with inflation. The Reserve Bank of India decides how much cash needs to be there in the economy, and the RBI controls the cash in the economy by a very powerful tool called the interest rates. Low interest rates mean easy money supply, that is high liquidity. High interest rates mean tight money supply or low liquidity. If money supply grows too big relative to the size of an economy, the value of the currency diminishes. Hence, prices rise. During COVID lockdowns, businesses were forced to shut down and the economy came to a standstill. To recover from this situation and boost the economy, the RBI reduced interest rates and borrowing became very cheap. Consumers borrowed a lot of money at cheap interest rates to purchase all kinds of products and services. This resulted in higher demands relative to supplies, and as a result, inflation went up. Printing money is not only an easy way for governments to deal with a slowing down economy, but also sometimes essential to save an economy from crashing. To reverse the situation of inflation or achieve disinflation, the money supply in the economy needs to be reduced. And to achieve that, the RBI has been increasing interest rates. The next big question is how are equity markets affected by high interest rates? Higher interest rate means higher cost of capital. The investing community is familiar with the concept of ROCE, that is, return on capital employed, which is nothing but the overall utilization of funds by a business enterprise. If we as investors want to make any profit by investing in a company, the company's ROCE must be higher than the cost of capital. Otherwise, the business would have to shut down eventually. During times of high inflation and high interest rates, the cost of capital goes up. This affects the ROCE. To understand the inflation situation better, we need to look into bond markets. In high interest scenarios, bond yields go up. So a lot of investors especially big institutional investors, take money out from equities and put in bonds. Hence, share prices come down heavily. The valuation of equities is done by discounting future cash flows with the coupon rate. So when the coupon rate goes up, the future cash flows are valued lower. Investors will not be willing to pay a high PE ratio in this situation. This affects valuations. Before we talk about sectors, let's have a look at what effects inflation might have on financial statements of a company. Rise in prices due to inflation should correspond to rise in nominal revenues. Hence, theoretically, share prices should go up. On the other hand, profit margins reduce due to higher input costs. If input costs don't rise at the same rate as revenues, profit margins could actually go up. The biggest factor in this situation is a company's pricing power. If the company has pricing power, it can easily pass on the higher input costs to its consumers. Hindustan Unilever has been successfully doing this for several decades now. A company's share price represents its valuation at the current moment. Valuations may be too high or low at any moment in time, but eventually the market brings the price of a share close to its intrinsic value. How does the market calculate the intrinsic value of a company? In short, discounted cash flows. Estimated future cash flows of the company are discounted at the current interest rate. Many experts, like Warren Buffett, calculate the intrinsic value of a company by DCF method long before the market does. That's how they become legendary investors. Value investing makes a return during inflation. So, how to invest during inflation? Historically, gas and energy stocks have performed well during phases of high inflation. But this time, due to the war between Russia and Ukraine, there has been a global energy problem. So, what options do we have now? Gentlemen prefer bonds. That's a quote by an investor named Andrew Mellon. He said this in regards to volatility of equities. Bond investment is actually a quite safe option these days. Recently, the yield of short-term bonds have risen sharply. The pioneer of value investing, Mr. Benjamin Graham, wrote in his book, The Intelligent Investor, that investors should diversify their investments between bonds and equities. The higher the risk appetite, the higher allocation should be given to equities. He broadly classified investors into two categories. The defensive investor, who should allocate 50% of his capital to equities and 50% to bonds. And secondly, the enterprising investor, who should allocate as high as 75% of his capital to equities and 25% to bonds. So in times of high inflation and high interest rates, one can reallocate by selling bonds and buying equities at cheaper valuations. Let's say I buy a tax-exempt bond, which are usually issued by public sector undertakings in India, and the bond pays around 8%. This 8% goes directly into my pocket. On the other hand, say HDFC Bank earned 8% profit in the year. If I have share of HDFC, my post-tax earnings from its share cannot beat inflation. However, investors should be very cautious about long-term bonds which are vulnerable to inflation scenarios. Based on the performance of the indices in the last 18 months, it's quite clear that equities remain very volatile during times of inflation. We can use this volatility in our favor by swing trading the Nifty. The Nifty 50 fell as low as 15,200 in June 2022 and it touched 17,900 in August 2022. That's a mind-blowing return of almost 18% in just 2 months. It's obvious that no one could have entered at the lowest point and exited at the top, but still, this approach would have beaten inflation by a huge margin. So the strategy here is to make volatility our friend. Inflation does not seem to bother the well-to-do as much as it affects the middle class. So we need to look into sectors which cater to the upper classes. One such sector is the wine sector. One of my favorite stocks is Radico Khaitan. Radico Khaitan has risen around 50% since June 2022. The interesting thing is that the market is happily paying a high PE multiple even in times when equities are beaten down. These are my strategies against inflation. What strategies do you like to use against inflation? Please comment below. Thank you for watching the video and have a nice day.